We got asked this several times in LP meetings.
We asked.
So, I think I'll frame ours, but I think first what I realized is that most value add is fluff, right? The majority of VC investors don't know what they're actually doing.
Peter Saddington, your big game hunter. And guys, we have our sights on someone special today. Only a mother could invest in this idea.
Made this like super artistic.
That is actually absolutely correct. And that's a very, very astute assessment, actually.
True startup story, guys. You got it. Your company just got seed round financed. Congratulations. You're going to the moon. But now you have to scale. You found great talent out in California, New York, Georgia, and even Eastern Europe. So what communications platform will you be using to ensure your international team is always aligned? Well, the answer is easy. Slack.com for Teams. We've used Slack for all of our previous startups, and they've supported us in tremendous ways. And we want to give them a thanks today for supporting vchunting.com. Did you also know that Slack is a great tool for personal use? Yeah, I use my own personal Slack channel to drop in documents, notes, to-dos, and follow-ups to ensure that my workflow throughout the day is right on course. I promise you, if you try out slack.com for personal use, you'll end up using it for your team as well. Go to slack.com to check it out. Welcome everybody to another episode of VC Hunting with me, Peter Saddington. You guys know that we're on the hunt for great stories behind the venture capitalists themselves. Today we have a wonderful guest, Henri Pierre-Jacques, who is the managing partner and co-founder of Harlem Capital Partners. Henri, welcome to the show.
Thanks for having me.
Well, tell us a little bit about your history. Obviously, you've spent 7+ years in the investment banking world and moved into venture capital with a $40 million fund focused on minorities as well as women entrepreneurs or women of diverse background entrepreneurs. So give us a little bit of history. How did you get into the venture capital world and what is keeping you here today?
Yeah, so I'm originally from Detroit, Michigan. Haitian born, and that's where my French name comes from. I went to school in Chicago Northwestern, did 2 years of investment banking, then Typico did 2 years of private equity. After private equity, went to business school. But while I was in private equity, my partner, who was actually my cube mate at ICV Partners, which is a firm here in New York, we were like, hey, why don't we invest our own money into businesses like we're doing at work for ourselves? So we started angel investing across asset classes. We were doing venture, small business, and real estate with no diversity focus. It wasn't our thesis at the time. Over time, we realized that the majority of our investments were into people of color or women. And we also realized that the majority of our deal flow was coming from venture. So we pivoted the syndicate to being focused on venture only for people of color and diverse founders. Fast forward 2 years later, Jared and I both go to business school at Harvard. We were roommates while we were there. And once recruiting started, we realized, hey, there's not. So we actually both worked at a Black-owned private equity firm. And once we got to campus, we didn't want to really work for a firm that didn't have any people of color at the top. And then we also wanted to invest into diverse founders. And so, this is 3 years ago. A lot of the funds that have raised second funds since back then were really too small to take us as employees. And so we made the decision, why don't we raise a fund ourselves? So, not knowing what that fully entails, we launched the fund between our first and second year of school, June of 2018. And then we closed the fund last fall after we graduated business school.
I'm sure there's so many learnings within the beginning of June 2018 to the closing of the fund late last year. What were some of the expectations you had moving into building your own fund, and what are some of the things that you completely had no idea would be as hard as it is to build a fund, or at least you guys were oversubscribed by like 15 million. Is that correct? So you guys had a lot. You guys had a lot of support behind you. So what were some of the lessons learned from raising your own fund, especially something this big, first time around?
Yeah, I did not think it would take 18 months. And typical first time fund is 16 to 20 months, so we were kind of in range, but you just don't think it's going to take that long, and it somehow always does. a lot of people who you think will support you won't. People who you don't know will. So, we were fortunate. We had 6 institutions in our first fund, and we knew none of those institutions prior to fundraising, and were able to build relationships during that 18-month period to get them to invest. But like there were, people, mentors of mine who didn't invest even small dollars that I thought would back me. And that can be very frustrating at first, because you need the people who know you to support you before others who don't know you kind of will support you. So that's frustrating. And then there's just a lot of administrative stuff. I think people think that when you're a GP, a general partner, that you're just an investor. And I would say day to day, 30 or 40% of my time is spent on deals. And when you're fundraising, that's even lower. We were actually doing deals while we were fundraising because we thought that would help the raise, and the end it did. But like while you're fundraising, that's 20 to 25% of your time is spent on deals. Fundraising can take up 50%. Then you've got we're very brand focused, so we're producing content. We've got intern classes, so we're looking to hire people, recruiting, managing them. And then you've got all the other stuff. Like right now it's tax season, so I just did our taxes last weekend for the fund. So there's a lot of things I think people underestimate. And then legal documents take a very long time, and they're super expensive. I think a big reason a lot of people, particularly of color and women, aren't able to get into funds because they don't tell you how expensive it is. Because you have to front load a lot of that cost. And then once you raise the fund, hopefully you actually raise it, then they will back pay you for the expenses you had. But like that's a big upfront cost. And when you're in business school under 30 years old with debt, that's not an easy burden to have. And so we were fortunate to have some people help to support us for that upfront cost.
And that right there is one of the biggest questions that I had in all these notes I wrote down around the research behind you is I couldn't imagine going through. So I've been through graduate programs. I have 3 graduate degrees, so I understand how that is. And I'm just thinking, just from my limited context here, I'm thinking, okay, brother is going through his graduate program, Harvard, of course, which, is obviously one of the easiest graduate programs to do. And in the middle of that, raise a fund. What was going through your mind? Was it just a simple thing of, hey, Jared Tingles is your co-founder, right? You and Jared coming together and saying, let's make sure that we raise this round at the moment in which it is the hardest moment possible. Was that it? How did that work out? And let me add on a little bit here. You got institutional financing, which usually for first funds, it's family and friends, close associates, close network. Like this couldn't have been this sounds like to me a recipe for absolute suffering. Walk me through this, because this is pretty intriguing to me.
Yeah, I mean, so we're definitely, I said this at the Forbes conference, we're probably the riskiest investment somebody can make, because both of us have never worked in venture capital. We came from private equity, so that was the first big question, like, what do you know about venture? Private equity is completely different.
Right.
We're both under 30, so we don't have experience from like a long-term track record. We're obviously people of color, we're investing in people of color, and we're doing early stage venture. Right. So like there's a lot of things against us, but I think to some extent that is what helped us. I think when people say, why would you raise in business school? I thought that question too, but after I look at it, it actually was perfect because one, it gave us the time to really take a step back and figure out, hey, what's the long-term strategy? You're not doing things where, every day that you have a meeting, you come home, if you didn't get a check, it's not as if, hey, I can't feed myself with food on my plate. It's, I'm going to go to class, or I got to read a case, or I'm going to Columbia for spring break. And if this doesn't work, then I'll go get a job at the business school. Like, I'll be fine. And so that level of freedom, like it starts to set in, as 3 months before graduation, when we only were at $12 million, like we got a lot of the money the last 6 months of that 18-month period. So when you're about to graduate and you realize, hey, this is it, no matter what we raise, like this is our management fee.
Right.
That's when it set in. But in the beginning, you don't feel it as much because you still think, hey, I could recruit. I've got some time. We'll see what happens. But I think also like the reason we got a lot of these institutions was, one, if you want to, like, part of our analysis was, okay, if we go work for Sequoia or NEA, will we actually be better investors in this space? As a VC investor, maybe, but I have friends who are at Andreessen or General Catalyst, et cetera, and they're invested in single digits in terms of like people of color, and then maybe they have double digits of women.
Right.
We're not going to see that volume that we see. We see roughly 1,000 deals a year. 80 to 90% of them are people of color or women. And so, like, from a volume perspective, I'm learning the habits more of this group than I would at a traditional firm. So that was one reason we decided, hey, now's the time. I think people respected that, and they understood, hey, you actually might not be better if you went to go work for a firm. And then two, from the institutional standpoint, a lot of people were like, oh, you've done private equity, you've never done venture. But we use that to our advantage, right? A lot of our mentors and bosses who are GPs and PE funds, because 15 of our LPs were GPs in other funds, like they knew a lot of these institutions, right? And so TPG's our anchor investor. We have a number of partners at KKR who are LPs in our fund. And a lot of these institutions have been investing in TPG and KKR, et cetera, for decades, right? And so when they've invested in those partners and they say, hey, why did you invest in this person? And you've made me a lot of money over 10, 20 years, like that goes a long way, and they're doing checks for you. And so for us, it was like, hey, we haven't worked in venture capital. Most of our capital came from New York. We know the New York ecosystem really well. There's a lot of money here. And this ecosystem understands private equity investors. They've known it for a longer period of time. So why don't we use that to our advantage, right? So we only got probably 3 or 4 VC GPs in our fund, and the majority of our GPs are from private equity funds, and then we tap their relationships to meet institutions.
Wow, that's amazing. That's amazing. In a Business Insider article not too long ago, February 20th, 2020, so a couple weeks back, you said that the long-term San Francisco is not going to be where diverse founders come to the top. Unpack that for us a little bit. Obviously, there's some bias towards your particular thesis of a venture fund, where you guys are obviously supporting minority startups and backing women. But tell us why. Tell us why that San Francisco is not going to be the place where diverse founders come to the top. What do you know that we don't there, Henri?
Yeah, I mean, so like we haven't invested in San Francisco, not on purpose actually. Like we've been trying. We've invested in 10 cities across the U.S. and none of them have been in San Fran. I think, from a woman perspective, the shift may be slower. From a person of color perspective, a lot of my friends and a lot of their peers are all leaving SF. Obviously it's expensive, but then it's not inclusive in my opinion. Even going to college in Chicago, which is a very diverse city, it's also one of the most segregated cities in the U.S. So cities like New York, where, I live in Harlem, and you can go to the Upper East Side within 10 blocks, and it's one of the richest, areas in the country. Like, you have such an integration because of the subway system, because the communities are so close. No matter where you are, affordable housing is a big thing in New York. So you could be in Chelsea, and then there's a project across the street, right? And so San Francisco, from a government infrastructure, didn't build the right transportation, has not done affordable housing, which is why you have so much homeless people. And that leads to just less integration. And particularly this hurts people of color communities more, just because of the institutional barriers that have existed. So I think San Francisco is going to have a challenge in terms of keeping that talent. So I think it's similar to corporate recruiting. People are focused on recruiting, but how do you actually retain? And so like, these high tech jobs, people are going to fly out and go to San Francisco because they're going to pay me a lot at Google or Facebook. But then if I don't feel inclusive and now I have to travel an hour to go to Mountain View and nobody wants to work in Mountain View anymore, I'm not going to want to live in that environment. So I just think you're not going to see a lot of talent at these tech companies that are diverse in those communities, particularly now that you see all the major tech companies building massive offices in New York or Atlanta, wherever it may be. So people have the option to work at Google or Facebook and be in other cities versus 10 years ago. If you want to work to Google, you had to be in San Francisco, and there was very few non-core people that weren't based there. And so I think that's really shifted where people are going. And then in terms of like who the investors are, like that's obviously going to have a pool. And when you look at diversity focused funds, most of them are gender focused. A lot of them are based outside of San Francisco as well.
Did you know that there's even more value than just audio or video? Follow us on Twitter, Instagram, TikTok @VC Hunting, and make sure to sign up for the VC Hunting newsletter, where you'll be able to get weekly news on venture capital, startups, founder stories, and the occasional wisdom extracted from Peter's brain. Go to vchunting.com to sign up. And now, back to the episode.
Awesome. And you and your co-founder, Jared Tingles, you guys are on a mission to fund 1,000 diverse founders over the next 20 years. How's that going so far? That's a lot.
We hit 22 last week. Um,
22. There you go.
yes, I mean, it's not.
That's what is that? 50 a year, right? 50 a year.
Yeah, I mean, so it's not linear, right? It's similar to fundraising. Like we want to raise $1 billion of capital by
Ooh.
2030, right, in the next 10 years. And investing in our view is pretty binary. If you're really good, the money will come.
For sure.
That's not going to be an issue. And so when you think about, okay, we'll raise another fund next year, and you raise a fund every 2-3 years. But as you get to fund 4, fund 5, you're becoming a multi-stage fund. You're going to have a growth equity fund, early stage fund. We might be a multi-asset class fund. So it's not like we're going to be doing 50 investments a year for the next 20 years. Like there's going to be a curve where you get to a point the last 5-10 years. And hopefully if we get to where we want and we're a multi-billion-dollar fund, like you've got 3-4 funds at one time that are doing 50 investments a year. So we understand the beginning will be a slower ramp up here. Like we don't want to do 1,000 investments for 50K checks. Like we're doing $750K to $1 million checks now, and that will continue to increase over time. So for us, it's not about the volume. Like that's not as important to us. It's more, are we making meaningful investments, getting real ownership and helping these companies raise? Because one thing we saw while we were angel investing and while we wanted to raise at least a $25 million fund is a lot of diversity-focused funds were writing 100 to 250K checks. A lot of seed stage funds, particularly outside of San Francisco, weren't leading rounds. A lot of people of color who wanted to raise $1 million, they were raising $500,000, and they were raising $500,000 in 6 months versus 3 months. And that makes it not competitive. And so we really wanted to raise a fund where, hey, can we get them to close the rounds faster? Can we get them to raise the capital they want to raise? And can we really set them up to actually be able to compete against non-minority founders? And so that's really more important. If we don't hit the 1,000, fine, but like set the goal, we'll go for it, and we'll continue to ramp up the fund sizes, and hopefully over time we get to that number.
Awesome. And I love this idea. You said you want to make meaningful investments. Obviously, one of the jobs of a venture capitalist is to help the founders get to the next stage, next round of funding, scale, traction, these types of things. What would you say? I mean, you're still under 30. And so what would you say, and this is not a diminishing point. I'm not using this as a diminishing idea. It's just sometimes people will say, hey, you got $40 million in your pocket, Henri. What do you bring to the table for these founders? What tactical or strategic value do you bring to them other than just the check itself? Do you help with the scale? What would you say is your secret sauce, if you can share it with us?
Yeah, I mean, we got asked this several times in LP meetings.
We asked
right? I think I'll frame ours, but I think first what I realized is that most value add is fluff, right? The majority of VC investors don't know what they're actually doing. And a lot of us haven't been doing this before the crisis. So right now is actually an interesting time because it's the first time that probably 50% of VC investors have actually had to experience like a downturn. You see VC Twitter kind of blowing up with the coronavirus and the market sell off. So it'll be interesting to see who survives. But I think a lot of founders, and I say that not from like an investor standpoint in terms of VC investors don't know what they're doing. Like this is what founders are telling me who have been with, reputable firms and have realized that like it doesn't actually matter. A lot of these funds don't, because in my view, coming from private equity, what I consider value add to me is a much higher bar. Like in terms of we're in our companies for days, we're sending them tons of consultants, right? And so making a customer introduction is very different than like what our value add would be in private equity. Right. And so my particular view is that if you're under $100 million fund in the seed stage, there's very few $100 million plus dedicated seed funds, particularly in New York. You've got USV, first round, and Thrive is kind of multi-stage, et cetera. Right. Then like you don't have a back office. You don't have a talent pool. You don't have web designers, right? You most likely have 2 GPs and maybe 1 associate if you're under 100 million seed fund. Right. So like, your value add is your network. You're making some introductions. Maybe you have an advisory board, but like you're not doing what first round is doing from a talent perspective. You're not helping from a design perspective like Sequoia, right? So like in the day, like all of us are in New York. We've all gone to Harvard, Stanford. Like it's not, to me, that it's not like a differentiator factor to say like you have a network or you can make introductions. Like that's kind of table stakes at this point. So I think there are very few investors that can truly add significant value add at like a deeper level than just network, or I'm going to be here to support you when you need me. Like we can all do that. What we found for founders is like the brand matters a lot. Like no different than TPG or KKR. Like there's tons of private equity, multi-billion-dollar funds, but like the brand is really important. It's why Blackstone wins deals. It's why Sequoia wins deals. And so like having a brand, we focus on content. We do podcasts like this. We host events. We have interns because like that resonates with people. And if you have a strong brand, then your network grows even faster and further than just your Harvard, New York network. Like nothing can grow faster than kind of the brand can go. And 50% of our deals come directly from founders. And that's really important. Like we've invested in Salt Lake City. We did a deal in DC a couple of weeks ago, Boston, LA, and a lot of these came directly from founders who saw articles on us, and they want to be a part of the mission. They've seen that we have Techstars partnerships, we have a TPG partnership, Dorm Room Fund invested in us, CTA invested in us, etc.
Which is your network.
Yeah, and that's really what's important for them. Like ideas and mentorship is great, but if you don't have cash, none of that matters. And like, if you're a YC founder who went to Stanford, obviously you have a different, level of like, hey, let me like kind of see who's the best. But like for a lot of founders who are in these cities or underrepresented, it's not like I'm choosing between Sequoia and Andreessen. When people ask like, hey, do you want to go to Harvard or Stanford? Like if I get into one, I'm going to either one. Like the few people that get in, I didn't get into both. Like the few people who get into both have that privilege of choosing, but like I only got into Harvard. I didn't get into Stanford. Like you go where you get in. And so I think people really overestimate like this like value add perspective. And yes, there's thousands of funds today now, but like there's still very few that have this like national brand presence. And like we're trying to be one of those at the seed stage. A $10 million fund that has one GP is just not going to have the brand presence of some of these other funds.
And so I really appreciate that, Henri. I could kind of get that feel from doing my research on you that you were kind of shooting for the stars. You want to go big, raise $1 billion over the next, the next 10, 15, 20 years or so. And I really appreciate that because those larger than life goals are really what can not only set you apart, but give you enough incentive and motivation to actually do it.
Yeah.
How does the saying go? If you shoot for the moon, if you don't land on the moon, it's okay because you'll land among the stars, which is still a big win at the end of the day. Would you agree?
Yeah, I mean, I think the irony is that as VC investors, you're asking founders to take massive risk, right, and to like put all their eggs in one basket and to shoot for the stars and have these crazy goals. And then as an investor, like we're trained because of who we're getting capital from, institutions, LPs, to be conservative, right? And so like I think there's some level of irony where it's like, hey, I don't have experience. That was a big question people had, but I'm investing in a lot of first-time founders. We have a few second-time founders, but I'm investing in people who've never done it. And so to some extent, like, am I better positioned as like somebody who doesn't have experience to invest in somebody who doesn't have experience? Am I better positioned as somebody who has experience to invest in people who don't have experience, right? Like you may say, hey, I worked at Facebook for 4 years and now I'm going to start this company, so I have experience. It's all relative. Like I've worked in finance for 4 years as well, right? So like that same level of experience as you do. So I think it's like an interesting kind of dichotomy of like investors are supposed to be experienced people, and oftentimes we're investing in inexperienced people.
I will tell you, Henri, the older I get, the more I realize that no one actually really knows what they're talking about.
They don't. But like I think if you accept that, it's pretty refreshing.
It is.
And like there's obviously a level of pressure like for us to raise that amount of capital at this age, and like we don't take it lightly. But there's a level of refreshing. And our LPs, I think, understand that it's like we're taking a bet and we're hoping that you can figure it out. And it's no different than when we give it to our founders. Like we're hoping you can figure it out. And if it works, then it works. Like then you're able to build a platform and have a fund for 20 years, and people can actually plow capital into you, and LPs can make real capital. Because at the end of the day, like LPs aren't investing in us so they can make 4x on $5 million. These are multi-billion-dollar institutions. Like they're investing in us because they believe we can be around for 5, 6, 7 funds, become a platform, and that's the risk they take. But like you have to take a risk in order to become a platform. And to be a good one-time fund is very different than I want to be around for 20 years as Sequoia, et cetera. And you have to like be able to build things in place for that to happen. It's not just about investing. Like there's so many other components, and that's what we've learned. And we've been fortunate to have GPs who've invested through multiple cycles, who've had multiple asset classes, et cetera. It's like hear their experience. Like because one of our partners at TPG always told us you have 2 jobs: investing and raising funds. And oftentimes they conflict with each other, right? Because your best investment in fund 1, you should hold for longer. but in order to raise fund 2, you should sell off part of fund, that investment in fund 1. And so you're constantly having these conflicting, but like your job is to continue to raise funds, right? And so you have to have liquidation events. You have to do these things, but it doesn't always mean that's going to be the best return for your earlier investors, right? And so like you're constantly thinking about this like 2-job position of, I got to do good deals, but like getting liquidity sooner or investing in companies that can have quicker markups or exits. These are all things investors may not say publicly.
Exactly.
But like they're all thinking about because they realize that like you want to raise more funds.
Of course. I mean, a fundraise, for those that don't know, whenever you get into becoming a venture capitalist, you're fundraising for the rest of your life, or as long as, the fund is around, given that you do a good job. But I really love this idea, Henri, of these big visions and of this idea of, hey, we're investing in founders who want to create their big dreams and go shoot for the moon. And we, likewise, as venture capitalists, should be a model for that as well, of taking on big risk. And this is really apropos, because on December 24th, 2019, on Twitter, I think you probably got, I guess you got this from your daddy or your parents, but on Twitter on December 24th, 2019, you said, one of my favorite quotes from my dad is, if people don't think your dreams are crazy, then you aren't dreaming big enough. So
you dug in deep.
Well, you joined Twitter in 2016, I believe. A little late, Henri, a little late. But I'm assuming you got these big dreams, the dream big mentality, or this dream big worldview from your parents. So give us a little bit of history, if you could. Well, you said one of your favorite quotes from your dad is, people don't think your dreams are crazy. If people don't think your dreams are crazy, then you aren't dreaming big enough. What's another big dream of yours, Henri?
Yeah, so that quote, it's probably April of 2018. I called my dad because an investor passed on it. It's like one of my close friends' dad, who's kind of a mentor to me. And I was like very upset. I was like, this like doesn't make any sense. I've known this guy for, at that point, 8 years.
He doesn't believe in me.
Yeah, he doesn't believe in me. Eventually he actually came in. But when I called my dad, like that's what he said, because I was really down on myself, and that's kind of like the fundraising early on. It's just people you thought would come and don't, and that really hurts. And for my dad, he was the one who was born in Haiti. He moved to the U.S. in 2013, and eventually became an orthopedic surgeon. And so when I wrote in my Harvard Business School essay, was like, if my dad, and he went to Harvard Medical School, if my dad can grow up in Haiti and then grew up in New York and Queens in the 70s and end up at Harvard Medical School, like, why can't I end up at Harvard Business School? So like, for me, it was more of less of a motivation of like, I'm going to go rags to riches, but more if my parents could go rags to riches, then like, I got it. Like, I have to be able to get there because I've been privileged, like to have parents and a support system that my parents didn't have. And so for me, it was always like a why not situation. And my parents always just like instilled that in me, though they both wanted me to be doctors my entire life. Eventually, they became okay with me working on Wall Street.
That's fine. I guess it works out at the end of the day for them. I'm sure they're very proud of you and hoping that you'll deploy this capital responsibly and safely. Yeah. Yeah,
they are. And then in terms of the question, in terms of like other dreams, I mean, when I think about like the 1,000 number is a goal, but like really that goal is because I want to create the most millionaires of color ever before.
I like this.
Right. And so like part of the reason we did this is because the wealth equity gap between whites and blacks has continued to grow. And there's been a lot of studies that have proven that education, 6-figure jobs don't lead to wealth creation. And so really equity and ownership is what leads to that. And if you look at like who have been the biggest growth of the billionaires list have been through startups, right? And through people starting their own businesses. And so for us, it was, okay, well, if we can fund people earlier stage, coming from private equity at a black-owned firm, we had no people of color CEOs at our firm, right? And so we realized pretty quickly, if we wanted to do private equity, we weren't going to be able to invest in diverse founders because $10 million EBITDA is a high bar. We have to move earlier stage. We have to go to venture. But even if we take that risk, we move earlier stage, we can actually create the pipeline and funnel where these people can eventually later, be bought out by private equity firms or do growth equity public. And so really that's one of my big goals is like, I want to create the most millionaires of color, ever before.
Ooh, well, that's perfect. And we're going to end right there because we got an internationally syndicated show here. And there's lots of founders and what I like to call the entrepreneur curious that love to see and hear about the stories of venture capitalists like yourself. So for everyone out there, if you are a person of color or a woman interested in, well, maybe some funds, I'm not promising for Henri. You have to have a good idea and be able to convince them. Feel free to check them out. Henri, I'm going to give you the final word here. Where can everyone out there learn more about you, more about your fund?
Yeah, our website's harlem.capital. And then across social media, we have handles on and everything for Harlem Capital. And then from a quick blurb, we're looking for seed stage companies based in the U.S. Typically post revenue, but we do post product as well. We do $500,000 to $1 million checks for 5 to 10% ownership, and we invest across industries. We've invested in 10 cities across 9 industries, so we're pretty agnostic.
And if I may say, as we're closing this out, Henri and his team are blowing up. I see them all over the webs. At least they're doing a good job branding wise. Maybe that's the secret. Well, thanks so much, Henri, for joining the show. I look forward to speaking to you again.
Sounds good. Thanks.
Well, wasn't that a fun interview with Henri Pierre-Jacques, who is the managing partner of Harlem Capital? Young blood, man, under 30 years old. I think he's 27 or 28 years old, but he's got a $40 million fund behind him supporting women startups and minority startups. Guys, that's just awesome. It's awesome to hear his story. It's awesome to be encouraged that he was able to grind through 18 months or 16 months or something like that. 18 months. From June 2018 to the end of 2019, being able to close this fund, oversubscribed, $40 million, just over $40 million. Congratulations to him. This is one of those stories that really just gives me a lot of just good feeling. If I could say it that way, good feeling in my soul that I can tell that Henri is just a respectable person, a sophisticated individual, smart, hardworking, all the things that you want in a venture capitalist, someone who coming from the private equity space, transitioning into venture capital and early seed stage ventures. It's just, I really hope, and I just really hope for the best. I really hope for the best for him and his co-founder, Jared Tingles. And they started this in Jared's living room in 2015. We didn't talk about that too much, but they started this in 2015 in his living room, where Jared was also a cube mate at an investment firm, and they were writing small seed and angel checks, and they wanted to just focus. They wanted to focus on the minority, in minority investing, women investing, and were willing to grind it out. And I think that's the thing that I'm getting from this, and I felt from this interview, is that if you have big dreams, just like the Twitter quote on December 24, 2019, one of his favorite quotes from his dad is, if people don't think your dreams are crazy and you aren't dreaming big enough, dream big. Dream big. Go at it. Go for it. Shoot for the moon. It'll be amazing, the people that'll show up and help you. And even those, and just as Henri said, sometimes you get disappointed by those that you expect to support you. But you got to keep grinding on. You got to keep doing it. You got to keep going for it. And the fact, like, if you just add up his story, raising during his graduate degree at Harvard for MBA, and going for such a big fund size, and it's amazing. Yeah, I guess where I really sit, my friends, in this retrospective, where I really sit is even though Henri comes from 7 years of private equity investment firm experience, and he's never been a founder, right, a startup founder. I think what I'm getting out of all this is just he's got the right grit, the right perseverance, the right mind, the right head on his shoulders to succeed as a founder, as to succeed as someone in business, because he's willing to persevere and willing to continue to grind and get it. Right? That's what I look for as an investor. I look for founders who have that grit, have that perseverance, have that ability to communicate, and also see the world for what it really is, the realities of it. I love this. When we were talking about meaningful investments, and he said, value add from venture funds is all fluff. Yeah, I mean, it is. Money is commoditized, right? And can you be the shoulder to cry on when the founder is in a tough position? Sure, yeah, that's easy. But what real value add do many of these early stage startup founders, or early stage companies, early stage funds, what can they really give founders? I mean, it's just usually a couple guys and an analyst or something like that. Can they really help? Can they really help scale? And what was really interesting is that Henri talked about brand matters a lot. I agree with that, and I think, and I agree with that. I agreed with that so much in my heart as he was saying that I wrote these notes down, but I didn't ask any other questions because I believe that's where we need to be moving in the future. Not the tier one funds. The tier one funds are already established. It's the tier two funds. If you want to really establish yourself, you got to establish yourself with content. That's what Henri is doing. That's what I'm doing. Establish yourself with content because people will find you through content. Yeah, the tier one firms, they got all the marketing and they got all the help that they're giving, all the resources that they're giving great founders and startups, yes. But the tier two, that's where they can pick up the slack. They can start creating great content, supporting founders in powerful ways and going above and beyond. That can be the real differentiator, especially if you're like Henri and you want to build something that's going to last even longer, like 10, 20 years. Build a firm, not just a fund. I hope you guys were encouraged through this interview with Henri Pierre-Jacques. I love this conversation with him. If you want more information on the field notes and all the stuff that I'm thinking about when it comes to this interview, find your way over to vchunting.com/Henri Pierre-Jacques for more information. Guys, I'll see you guys next time. Peace out.